TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
So what if I told you that the financial news headlines you read every day, the dramatic geopolitical escalations, the emergency press conferences, the constant breathless updates just pinging on your phone? What if I told you all of that is completely irrelevant to why the stock market actually moves?
It's a pretty wild thought, right? Because usually when we look at the market, we expect this very simple equation like good news equals green arrows, bad news equals red arrows.
Right, exactly. It's clean.
Yeah, it gives us this sense of order. We really want a story to explain the chaos of the ticker tape.
We do. We want to believe that millions of rational investors are reading the news and then collectively deciding what these companies are worth in real time.
Right. But when you step into the world of modern market mechanics, that whole simple equation just completely shatters.
It really does. I mean, when you look under the hood, the financial landscape we're trading in is honestly just a massive, high-stakes magic trick.
That's a great way to put it.
And those news headlines everyone is obsessing over, they are just the misdirection.
Absolutely. It is the defining reality of modern market structure. While the entire retail trading world is glued to the magician's right hand, the breaking news, the actual heavy lifting is being done by the left hand, completely in the shadows.
Yeah.
We're talking about dealer hedging, options expirations, and just pure mechanical forces.
Which brings us to our mission for this deep dive.
Yeah.
Because we're going to unpack a highly revealing stack of spot gamma reports from late March to early April of 2026.
Right.
And our goal today is to show you how to look beneath the surface of the S&P 500, the SPX, and really understand the raw mathematical machinery that is actually driving the action.
Yeah, and to really set the stage for you, we have to look at the incredibly chaotic environment of this specific week in late March 2026.
Oh, man, it was wild.
It was. There's this escalating geopolitical conflict in Iran, right? The situation's just deteriorating rapidly.
Yeah, and Donald Trump has this looming 9 p.m. national address scheduled to discuss the conflict.
Exactly. And the stock market is just bouncing wildly, whipping back and forth all over the place.
Which sounds terrifying if you're holding a portfolio. And of course, the financial media is on TV all day, tying every single tick of the stock market to these geopolitical events.
But look, while everyone was glued to their screens waiting for Trump's address on Iran, here's the secret.
Tell them.
The market's algorithms do not care about the politics of that speech.
No, they don't.
And neither do we in this deep dive, by the way. I want to be super clear. We aren't here to debate foreign policy. We aren't taking any sides on the conflict, right?
Right, we're certainly not judging the policies or anything like that. We're impartially reporting what the sources say.
Exactly. We are strictly looking at the cold, hard math of how the institutional machinery mechanically reacted to the injection of that news.
We're just following the money flow. And the core thesis of our analysis today is that the wild market movements during this chaotic week, they weren't driven by, smart money making rational long-term decisions based on Middle East geopolitics.
Not at all.
No, they were driven almost entirely by the rigid mechanics of the options market. Specifically, a massive position known as the J.P. Morgan collar strike.
Yeah, the JPM collar. And if we pull this thread, it completely changes how you see every market rally or sell-off.
No, totally.
Because going into the end of March, there was this gargantuan options position anchored heavily at the 6,475 strike level on the SPX.
Right, 6,475.
Yeah, and this is known in the institutional world as the JPM collar. And it was set to expire at the end of the quarter, which was March 31st.
Okay, before we go any further, let's just break down that jargon for a second. Because what physically is a collar in this context? And why is one single bank's position dictating the entire S&P 500?
Good question. So a collar is essentially a defensive insurance strategy for massive portfolios. Imagine you hold tens of billions of dollars in stock.
Okay. Sounds nice.
Right. But to protect yourself from a sudden market crash, you buy put options, which increase in value if the market drops. But buying that much insurance is incredibly expensive. So to pay for those puts, you simultaneously sell call options above the current market price.
Which caps your upside if the market rallies.
Exactly. You've collared your risk.
Yeah.
And JP Morgan runs this massive multi-billion-dollar strategy every single quarter.
Wow.
And because the size of this trade is so enormous, the market makers on the other side of that trade are forced into highly specific hedging behaviors.
Right. So we have market makers, the dealers who actually facilitate these trades, and they aren't in the business of gambling on whether the market goes up or down, right?
No, not at all.
They just want to collect their transaction fees and stay perfectly neutral.
Precisely. They want what's called the delta neutral book. So if they sell a massive amount of options to a client, they suddenly have a ton of directional risk.
Right, because if the market moves the wrong way, the dealer loses billions.
Yeah, they get wiped out.
Yeah.
So to stay neutral, they have to constantly buy and sell the underlying S&P 500 futures to balance out the risk of the options they just sold.
And this brings us to a really crucial concept, negative gamma.
Yes, the big one.
Right, because in a negative gamma environment, as the price of the SPX drops and approaches a major structural level, like that 6,475 strike in the JPM collar we mentioned, it acts like a massive magnet.
It really does. The math literally dictates that dealers must sell futures as the market goes down, which in turn pushes the market down even further.
It's a feedback loop.
Exactly. But conversely, if the market bounces up toward that strike, they are mathematically forced to buy to cover their positions.
Right, and they aren't buying because they watched a news segment about Iran and suddenly felt optimistic.
No, they are buying because a computer algorithm is flashing red, telling them their hedge is unbalanced.
So think of that 6,475 strike like a massive planet's gravitational pull in space. The closer the market's price gets to that planet, the faster these institutional dealers get sucked into its orbit.
That's exactly how it works.
They're pulled into buying furiously, regardless of what the news anchors are saying on TV. The gravity of the options market just doesn't care about the news.
The gravity dictates the flow. The underlying mechanics just completely overwhelm whatever narrative the media is spinning at the moment.
Wait, hold on, though. If I'm sitting at home watching a major news network announce, potential peace talks in Iran, and my portfolio suddenly spikes, you're telling me those two things are just a coincidence?
Well,
Because that's a hard pill to swallow. I'm looking at the cause and the effect right on my screen.
I know. But here's the thing. Retail traders watch the news. Institutional algorithms watch the flow.
Right.
And the spot gamma data reveals how this actually played out. The peace talk headlines provided a tiny spark, like a fractional upward nudge in price.
Just a little bump.
Just a bump. But once that price nudged close enough to the 6,475 strike, that gravity you just described took over. Dealers were forced to frantically buy to hedge their options. The news was just the excuse. Yet without the mechanical presence of that 6,475 strike acting as a vacuum, that massive end-of-March rally wouldn't have even happened. The initial spark from the headline would have just fizzled out into nothing.
Okay, let's actually look at the math on this, because you have the spot gamma data for 2 consecutive days that just completely contradict each other, and it proves this illusion perfectly.
Oh, it really does.
We're moving from the theory of gravity to the hard data of the tape. Let's contrast Monday, March 30 with Tuesday, March 31.
Okay, so Monday, March 30 is a textbook example of what true selling looks like in the market. Our sources highlight a metric called the IRO indicator.
Right, HRO.
Yeah. And IRO tracks cumulative aggressive options delta. In plain English, it shows us the real-time money flow of institutional hedging. On Monday, the IRO indicator logged a massive negative $8 billion delta reading.
Negative 8 billion. I want to understand the exact mechanics of that number. How does an options indicator force the broader stock market down?
Let's walk through a single transaction. Imagine a massive hedge fund looks at the situation in Iran and decides they need to protect their portfolio over the next 6 months.
Makes sense.
Right? So they buy 1 million long-dated put options. The dealer on the other side of that trade just sold those puts, meaning they took on a massive amount of downside risk.
Because if the market crashes, that dealer is on the hook for billions.
Exactly. So what is the dealer's immediate reflex to protect themselves? They short the S&P 500 futures. Now multiply that reflex by thousands of institutions. Because clients were heavily buying long-dated puts for geopolitical protection, dealers were relentlessly shorting futures all day just to hedge.
Wow.
This forced the market to slowly, painfully grind lower. It wasn't a sudden panic. It was a heavy, mechanical downward grind driven by hedging.
So the market is incredibly heavy on Monday, grinding down under $8 billion of selling pressure. But then the calendar flips to Tuesday, March 31st.
The big day.
Right. This is the end of the quarter. It is the expiration day for that massive JPM collar we talked about. The SPX crosses that magical 6,475 threshold, and the gravity kicks in. Gamma expands violently.
And in a matter of hours, that heavy, grinding market completely vanished.
Yeah.
The IRO indicator magically flipped.
Yeah.
We went from $8 billion of selling pressure on Monday to registering a positive $5 billion in net delta buying pressure on Tuesday.
That is insane.
Dealers were scrambling over each other to buy.
Let's look at a jaw-dropping example of what that scramble actually does to the pricing of these derivatives. Because of this massive gamma expansion on Tuesday, the 6,470 0 days to expiration call option.
The 0 DTE call, yeah.
Right, a 0 DTE call that expires at the end of that exact same trading day. It skyrocketed from $2 a contract to $60 a contract.
Yeah, and the underlying delta of that specific option shot from sub 10 to over 80.
Wait, explain what that means for people who might not trade options.
Sure. So for context, an option with a delta of 10 has a very low statistical probability of paying out. It's essentially a lottery ticket. But when the delta shoots over 80, that option starts acting almost exactly like owning the underlying stock itself. It becomes highly sensitive to every single upward tick of the index.
So, okay, if I didn't know about this gamma expansion, if I didn't know the JPM strike was acting like a magnet, I would look at Monday's massive sell-off and Tuesday's explosive rally and think, like, the entire global economy just solved all its problems overnight.
Exactly. You'd think the world changed.
How do you even survive trading in a market that is acting that schizophrenic?
It is the ultimate trap for the uninformed trader. But the experts in our source material outline a very clear rule of survival. Don't trade the price. Trade the reason the price is moving.
Trade the reason.
Yeah. If you see a massive green rally on your screen, but you look at the underlying delta flow, the IRO indicator we talked about, and you see that dealers aren't actually buying to hedge, then it is an artificial fake rally.
I see.
And artificial rallies are structurally fragile. They are ready to be faded, meaning traders will bet against them. You have to trade the underlying mechanics, not the mirage on the surface.
Okay, but if the stock market's daily moves are just, a house of mirrors built on options flow, where does a rational person look to find the actual truth of the economy?
You need an anchor.
Right, you need an anchor. And our deep dive sources point to one asset that the options market cannot easily manipulate.
Crude oil. During a geopolitical crisis, especially one centered in the Middle East, crude oil becomes the unfiltered, undeniable barometer for equity risk.
Because you can manipulate a digital index with billions of dollars in zero-day call options, sure, but physical barrels of oil being shipped across the globe on supertankers?
Yeah, much harder to push around with financial engineering.
Exactly. And the spot gamma reports actually break this down into a really helpful cheat sheet. They define 3 specific tiers for crude oil that dictate how you should view the health of the stock market.
Right. So the first tier is the green zone. That is when oil is trading below $90 a barrel.
Okay.
If oil is sitting there, it means the macro environment is risk-on for stocks, and analysts were looking for the SPX to safely push up over the 6,800 level.
Then you have the yellow zone where oil is sitting between $90 to $100. Things are, relatively okay. And structural support levels like that 6,475 strike have a very good chance of doing their job and holding the market up.
Yeah. And finally, you have the red zone.
Oh, boy.
Oil over $100 a barrel. The reports explicitly refer to this as the O'Shea scenario.
Don't mean the French, but yeah.
When oil crosses $100, it brings the severe risk of 2 to 3% daily drops in the stock market. And it risks sending the VIX, the market's fear gauge, spiking over 40.
Okay, so let's look at what was actually happening on April 2. The equity markets are artificially bouncing around trying to hold on to Tuesday's mechanical rally. But WTI crude oil is trading at a massive $112 a barrel.
Yep, way into the red zone.
So why is the stock market flashing a green thumbs up on Tuesday when the ultimate risk barometer is sitting at $112 just screaming that the roof is on fire?
Because the equity market was temporarily blinded by the structural short squeeze we just unpacked.
Okay.
The options mechanics mathematically forced buyers into the market, creating this localized reality distortion field.
That makes sense.
But oil was telling the true macro story. The commodity market was reflecting the actual bombs, the real-world supply chain disruptions, the tangible escalation.
Right, the real world.
Relying solely on a stock chart during a mechanical squeeze is incredibly dangerous for exactly this reason. The stock chart was lying, the oil chart was telling the truth.
So what happens when that distortion field finally fades? Because we are heading into Thursday, April 2. The massive options expirations, often referred to as OPEX, from March 18 and March 31, are now officially in the rearview mirror.
They're gone.
The JPM collar is gone. That artificial 6,475 safety net has completely vanished. Oil is flashing deep red at $112.
Yeah.
And yet, looking at the data, the market seems almost comically unprepared for what's next.
Yeah, we enter the report's term the volatility trap.
Yeah.
You mentioned the safety net is gone, right?
Yeah.
Think of those major option expirations as downside buffers.
Mm-hmm.
When there is massive open interest in put options sitting below the market, dealers are positioned in a way that actually dampens volatility as the market drops.
Like a shock absorber?
Exactly. Their hedging requirements provide a sort of structural friction. But once those options expire, those buffers are wiped off the board.
The structural friction is gone.
The training wheels are off the bicycle.
Let's break down the massive volatility mismatch that the data shows for April 2, because this is where the trap just snaps shut. We have to compare realized volatility to implied volatility.
Okay, so realized volatility is what is actually happening in the market day to day. And heading into April 2, the 5-day realized volatility was popping off at over 27%.
Which is huge.
Huge. In practical terms, that means the S&P 500 was consistently making massive moves of greater than 1.5% every single day. The market was violently thrashing around.
But then you look at implied volatility, which is what the options market is predicting will happen.
Right.
At 9:30 a.m. on April 2, a zero-day straddle, which is an options bet on how much the market will move in either direction that day, was pricing in a mere 85 basis point move.
Just 0.85%.
Right. For anyone doing the math, just 0.85%. In dollars, they were pricing a massive volatile daily straddle at just $55.
And to give that $55 price tag its proper context, that straddle was being priced while overnight futures were already down 140 basis points, or 1.4%.
Wow.
And why were they down? Because Donald Trump had just given his 9 p.m. presser outlining greater conflict in Iran. So you have massive overnight drops, actual daily moves of 1.5%, and the options market is just shrugging and saying, we'll probably only move 0.85% today.
Pricing a chaotic daily move at just $55 in that environment? I mean, that is literally like buying premium hurricane insurance for $1 while the storm is actively ripping the roof off your neighbor's house right in front of you.
It really is.
It makes absolutely no sense.
And not only is the roof ripping up, but the insurance company just left town. It makes no sense fundamentally, but it happens mechanically. And this volatility trap is precisely where retail traders get wiped out.
Because they think it's safe.
Exactly. When implied volatility is priced at a massive discount to realized volatility, it means the market is severely underestimating the potential for a violent downside move. The options are far too cheap for the amount of real-world risk present in the system.
Because the market makers just cleared their books, the downside buffers are gone, and everyone is staring at a cheap insurance premium while physical oil is sitting at $112.
Yes. Without those structural options positions forcing dealers to buy the dip and provide that friction, there is absolutely nothing to stop the market from falling if a real panic sets in. The floor has been removed from the building.
So the key takeaway from this stack of Spot Gamma reports is that you have to fundamentally change how you consume financial news.
You really do.
The headlines you see on your feed, the peace talks, the press conferences, the escalations, they are just the trigger. They are the spark. But gamma, dealer hedging, and the true macro risk of oil, those are the actual drivers.
They're the engine and the steering wheel.
Exactly. If you want to understand why your portfolio is moving, you have to stop trying to predict geopolitical news and start tracking the mechanical flow that actually forces institutions to hit the buy or sell buttons.
And if you need proof of how vital it is to track the mechanics instead of the headlines, I want to leave you with a chilling historical parallel taken directly from the founder's notes in our source material.
Oh, this is fascinating.
Because we have seen this exact structural setup before. If we rewind exactly 1 year to March 2025.
What happened in 2025?
So in March 2025, we had a weak market that was grinding lower day by day due to news headlines about tariffs.
Okay, so a slow grind lower driven by geopolitical news.
Exactly. But that grind was supported by the massive JPM put option that was set to expire on March 31st, 2025.
The exact same structural magnet anchoring the market.
The exact same magnet. So what happened after that magnet expired and the calendar flipped tack April?
Tell me.
April 2, 2025 became known in the options community as Liberation Day, With structural positioning support cleared out by OPEX, the training wheels were off. The bottom completely fell out of the market, and it dropped 10% in just a few days.
10% in a few days. Because the illusion ended, the buffers vanished, and the raw mechanics took over.
Precisely.
So now that the March 2026 OPEX has cleared the board, the downside buffers are gone, and that artificial gravity holding the market together has vanished. The question isn't what the news anchor will say tomorrow.
No, the question is much more structural.
The question is, are you prepared for another Liberation Day? Thank you for joining us on this deep dive. Next time you see a dramatic headline making the market jump, remember, look away from the magician's right hand and watch the mechanics. We'll see you next time.